Welcome back to the Stock Market Options Trading Podcast. My name is Eric, and this is episode 17. And what a great discussion this one is going to be. I think you're really going to enjoy this. I talked with Rance Maschek and Chris Mercer from marketgear.com, and we covered a lot of topics because, listen, when you get the opportunity like I did today to ask questions to industry experts, guys that have been in this business on the other side of it, we're on the retail side and these guys are on the other side. They really opened up for me and I really appreciate it. And so when you get that opportunity, you're going to take advantage of it. So we talked about all kinds of things. In addition to covering their software from marketgear.com, we talked about how technology in the industry tends to get stifled after a large brokerage firm seem to buy up these smaller firms or smaller companies. We talked about how Robinhood actually makes money. We talked about how backtesting can shorten your learning curve in trading. That's something that I've sort of already known and we share on this podcast and on the YouTube channel, but it can really help you get there faster when it comes to your trading, and how their software can actually help with that back testing. We talked a little bit about fractional shares and why they even exist, and one of the things that I really took away here, and I've already known, but they really hammered it home for me, is the importance of proper trade journaling and really how difficult that can be, especially with options trading. And their software is able to help with this too. So I'm going to be looking at that. So I wanted to share that with you. And we talked a little bit about tracking institutional activity using their software as well. So real quick, after listening, be sure to check out marketgear.com/Eric, ERIC, for a special promo for listeners if you're interested in upping your game. And real quick before we get started, there were a couple spots in the audio where Zoom dropped out. So there's a couple spots where if it doesn't quite make sense, that's pretty much what happened. The audio went silent for 5 seconds or so. But anyway, we had a great episode. All right, enough about the intro. Let's get into the discussion with Rance and Chris from marketgear.com. All right, Rance, Chris, welcome to the show. I really appreciate you guys spending some time with me and my listeners. I'm definitely interested in learning about iVest and Market Gear, the software you guys have been working on. But I want to take a moment to give a little background from you guys for my listeners. Give me a minute or two of how you got in this industry and what you've seen over the years and a little bit of your history as
I've been worked as an educator in the space for quite a while at a company doing training on stock and options trading. And one of the things that I found was there's just lacking in some of the capabilities in software. And so we started building something up there, ended up being acquired by TD Ameritrade, and in a very short period of time became director of options trading at Ameritrade. And what a tremendous experience being able to work at the time with like 8 million clients and seeing what they were doing and educating on options and capabilities here and driving a lot of the development at Ameritrade and what they were offering around options specifically in that case. And there were some things that was very frustrating to me when I was at the brokerage about what people or what the brokerage would let us develop and focus on. And so when I left there, started building out the platform we're going to be referencing a little bit today, and really doing things that the average retail trader needs and should really consider in their trading experience. And so we put this together, had great success with it, and great stickiness with it because we're providing a lot of things that the brokerage firms are just flat out not. So really, it's kind of a quick snapshot of the background, but both from an education standpoint, working with new traders, bringing them through the process, and then also working at a brokerage firm where you had a broad spectrum of experience, and from that, then building out what we've done since then.
Gotcha. Okay. Chris?
Yeah, I've been in the industry since the early 90s as well. I ran a NASDAQ firm back in the 90s. I ran the trading desk at that firm, so I was an old school market maker back in the day. It's not really something we see much anymore because of the computerization, obviously. But I was there for quite a while. I left the firm to start an education company for stocks, options, and futures, and then eventually added Forex. And in the process of adding Forex, I had a Forex broker that I got wrapped up with that wanted my education for their users, and I started kind of doing some side work for them. And that brought me closer into the industry itself. That firm ended up getting bought out by a company called MB Trading, which was a great trading platform for many years for active traders in the market. And then that got bought out by Trade King back a few years back. And so I worked for Trade King. And what I did there was basically ran what we call the API business, which was, we were the broker and we were looking for alternative technologies for our customers to use that could plug straight into their account, so they could, instead of just having to use the platform that we offered, if they had other things they wanted or they found, they could plug it into our their account at our firm and trade with it. And so I was always loved looking at different software and different things that were out there in the industry. I've been a beta tester for platforms, including eSignal, AIQ back in the day. I've helped them with some developmental stuff as well. And then eventually Trade King got bought by Allied Bank. And at a certain point after that, I moved on and moved over here to iVest with Rance. A lot of it was because I saw the product when we were at Trade King and Ally, and the way it plugged in, and the customers responded very well to it. And I just felt like it had a lot of things that most platforms don't have in this current day and age. And was really, they were really pushing the envelope. And so I'm happy to be here and working with this.
All right, great. Yeah, I know the technology over the years has really evolved a little bit. I know as a independent retail trader. So a little bit about my background for you guys. I kind of got in. I was an Invest-Tools student for Thinkorswim. I was not good with time. 15 years ago, something like that. And that was my foray. So I did see this what at the time was sort of this complex platform for me, because options are a little tricky when you get into it. It's not that simple as just buying and selling at the beginning. But they did have this educational component that got me kind of wrapped in, and I got sucked in. I've been kind of doing it ever since. One thing that's crept up in the past few years that I've been using more is backtesting modules, really with options. There's been backtesting for a while, unless you were like a coder or something. And I know NinjaTrader and some of these other platforms you could do some things with, but to the lay person, if you will, being able to backtest those in some kind of GUI been very difficult. And I think there's a lot more tools available now. And I'm glad to kind of have you guys on because I feel like you guys have been through that evolution, and maybe kind of give us some hints as to what's coming. I had an interesting comment, if you will, in my Facebook group. A guy, I mentioned that I was going to be talking with some industry guys like yourselves, and one of the things this gentleman mentioned was there has been a lot of smaller companies that crop up, and then they get bought out by the big companies, and they feel like sometimes those products either get washed away or diluted or something like that. Have you guys seen that? I mean, you mentioned a few companies bought this and bought that. I know TD Ameritrade bought Thinkorswim. Have you guys seen a lot of that? Like what happens like after they buy? Like I know when TD Ameritrade announced that they were going to buy Thinkorswim, I was like, uh-oh, what am I going to do? Kind of like there was a little worry there. But what have you guys seen on that? Like how companies, do they actually integrate it? Do they, what happens after that happens? A buyout.
Go ahead, Kristen. I'll jump in on that one as well.
Well, yeah. I mean, I've seen it. But the biggest issue is, a lot of times in the mergers, the technologies are not compatible. So what I would call legacy issues, right? You're one company buys another company, and trying to fit the pieces together after they're done with the merger, and they've moved their customers into one pool, and they've done all the what they call onboarding to put everybody into the same name. But there's a lot of the technology work in the background, and what you start to find, actually, you'd be amazed how many. I'm not going to name brokers. Maybe Rance will name brokers. I don't know, but I'm not going to name brokers. But there's definitely a lot of brokers in this industry where there are pieces of the technology that are still basically operating on a backbone from the early 2000s. And now you try to grab something new and realize, ooh, this isn't that easy to meld in, and then sometimes they figure it out, or sometimes they have to upgrade the back end stuff that you didn't know about, and sometimes they have to actually give up on it. I've seen all of those things happen along the way, and I'm pretty sure Rance has too.
Yeah, so one of the things that I know, so I happen to be at, I was the director of options trading at TD Ameritrade when Thinkorswim was acquired, and was very much involved with that integration. And what Chris is saying here is absolutely the case where, it's square peg, round hole. You've got different technologies, you're trying to make them work together. And with some of these legacy, companies that have been around for a while, they're on the backbone of their technology is not the latest stuff. And so it does make it difficult. And what does tend to happen, and you saw this in the case of Thinkorswim, and, now Mercer has been acquired by Schwab, and I'm sure going to see the same thing. When these integrations happen, it's all hands on deck to do the integration. So innovation stops. Development of new features, new capabilities, slows down or stops. And then on top of that, as they move forward, they have to deal with all of these things that don't quite mesh well. So sometimes it makes new development difficult. And that's why sometimes you see some of these other firms coming up that get a little bit of some newer technology. Like, for example, Robinhood, which we were talking about a little bit ago, where they've got a newer base of technology. The challenge is they don't have enough of it yet. And so you definitely see those kind of things happening in industry. And the lack of, when these mergers happen, the biggest thing I see is stagnation of development of new capabilities and new features that, as the market evolves and shifts, are really needed. And so that's, one of the things that I think that quite honestly helps us, because we are on some of the latest technology and we're able to drive this forward and connect to multiple brokerage firms. So,
right, yeah, and it's what you said is exactly what my colleague or my buddy in the Facebook group said was, it seems like the innovation does get stifled once that big firm sort of takes it over. And so let me switch gears real quick about these bigger firms. There's been an evolution of fees and fractional shares. More weekly options have come about over there. A lot of things to obviously get more people in the game, but also to keep people busier. And so, like with weekly options, there's a lot more options and more times and things you can trade. But what I don't understand is, what's the long game for some of these firms where, I get, with like a Schwab or somebody who has like umpteen trillion in assets, how does Robinhood make money over time? Is it a game of eventually you'll have enough money to where you'll want help and then they'll offer services to the people with the bigger accounts? Or how does Robinhood and these reduced fees, how does that work? Play out for them? Mm-hmm. Yeah, how does that work?
Well, one of the things that happened here was, Robinhood came out with, no commissions on stock, minimal on options, competing against the $10 tickets at, the big firms that were there. And what has happened now is, pretty much all the firms have gone to no commissions. Well, then how do they make money? Is it, exactly what you're saying? Well, in the cases of a Robinhood and a TD Ameritrade, what they're doing is they're selling your order flow. They're making money off of the trades that you're doing. They also make money on money sitting in that account a little bit, although in today's interest rate environment, not very much. But what used to happen, and you're with a firm that's charging a commission for your options trade, for example, you get price improvement. You have this bid-ask spread, difference between what you buy it for and what you sell it for. That's the published trade, but you could work between that. Well, now what's happened is, when those orders get executed, so then you take somebody like Robinhood, what they'll do is they'll work with a primary execution firm that will give them a kickback for sending them the trade. So it's called payment for order flow. So when that trade goes there, that it gets executed, then there's money that gets, that goes over to Robinhood for that order going to them. And the challenge with that, and this is the thing that I've noticed this without question since the change went to zero commissions on these others, on these other firms as well, is that price improvement has waned. Right? You don't get as good of a between that spread as you used to do. And, if you're doing a large trade, a nickel can make a big difference. And, if you're doing a 10 lot options trade, so it's 1,000 a share, a nickel's a big deal. Where now it's harder to get that price improvement because there's kickback going to the firm. So they're still getting paid. They're just getting paid from where the order goes, which one of my concerns is then where is that firm's loyalty? Is it to the people that are paying them? I mean, they need the customer to be able to get the flow, but where is it really going to, where's their focus? And the other thing that I'll tell you that's also happened here is because it has reduced income to the firms it has also had an impact on R&D, on development of technologies for the users, because they don't have the same pockets that they had before, a little bit less coming in. Now you take it something like a Schwab, they have money management and things like that as well. That so they want a share of wallet. They want that larger share of wallet, not just your active trading stuff, because they want to get into the money management, and that's how they make money there. But in the newer firms coming up like Robinhood, they're not at that point yet. They're just looking at making money off the flow of those orders coming through, or a little bit of interest on the money you have sitting there. So it's a very different model, and it makes it hard for them to continue to develop and grow some of the capabilities. And you see that at Robinhood. I mean, Robinhood has done a great job of bringing in younger investors, which is awesome. But one of the challenges they have is that they make it sound so simple, because it is really simple. The problem on their system, the problem is it doesn't have enough information to make a really good, well-rounded decision, because they tried to keep it super simple. And then you have people that get in trouble in trades because they didn't have the information they really needed. So there's a little bit of push pull there, but that's what we've definitely seen. And it, the kind of dirty little secret they don't like to talk about is they're still getting paid for the trades, just not from you. They're getting paid from where they send them.
Well, and also keep in mind, it's not like Robinhood was the very first broker that ever tried zero commissions. There was a firm called Zecco. In the past, there's been other firms. People have gone out and the idea was by saying zero commissions, and back then there was a lot more payment for order flow. What they wanted was to get as many customers in the door. And there are competing models, like Rance said, out there. One model, if you want to start out strong, is to basically give stuff away, right? And so Robinhood succeeded very well in the free model before everybody was free, with a platform that was super simple to use, almost like we would say too simple. It's like a social media that happens to trade stocks, essentially. And, it got the eyeballs. They got enough people on board that there's a value to that. There's a value once you have so many people that will listen to you, and then you start to steer the ship and figure out how you can make money off of that. So they took that approach, whereas, the other end of the spectrum, as you mentioned, Schwab, the big name in money management, I mean, they got to the point where commissions, I believe, and I could be wrong on this, but I believe that I saw it when they went to zero commissions last year and led the industry to zero. They were like 8% of their revenue was commissions, and everything else was in the interest and the money management fees and all these other things. And whereas you look at some of the others at the time that were still charging and were dependent, and maybe their commissions were still 30-40% of their revenue, and so they got hurt because they had to go to zero when Schwab went to zero. And, that really shifted the industry. And so, it is just different models. We like to say, by the way, there's 6 buckets of customers out there. Everything from, on one side, the guy that just basically is just learning, doesn't want much, buys and sells once or twice a year, all the way to the extreme 6th bucket, which would be your active day trader running a few trades a day or more, and everything in between, right? Somebody that knows about options and stays involved every day, that type of thing. And, you can see where the target is, right? And the target for Robinhood was on that first bucket, whereas, a lot of Ameritrade and everything else is more in the middle. Certainly what we look at is trying to build new features for customers in the middle, right? Try to give things that again, because the whole industry has not really innovated for the last 6 or 7 years. There's been too much merger and acquisition and trying to integrate. We have been able to work on things that nobody else is doing within the platform and target that middle group better than worry about the extremes.
Something you said kind of made me think, so I have kids in school, right? They're younger. My son's in middle school. My daughter's in elementary school. And I'm pretty sure at this point, there's zero financial education in the schools. Mm-hmm. And if you listen to the teachers, and by the way, I used to teach middle school 20 years ago, the public, I won't say public education because there really isn't any, but the public education of it is you're going to go to school, go to college, save your money, get the 401k, and then hopefully if you've saved enough, you can maybe live off your 7% per year. Like that's still this kind of overarching theme in society, So to see Robinhood come out and engage this younger demographic who I'm pretty sure didn't really learn a lot in high school, if you will. You got a lot of teens and 20-somethings buying fractional shares. They were able to engage, and part of that has to do with the world is faster. We have apps and things today that can enable that for people. But long story short, what I'm sort of prepping my kids for, at least, is that 401k probably isn't going to be enough. It's not going to be there. If you're working that gig economy, do you even have that option?
Right.
And so being able to manage your money, I think one thing, the one good thing that's come out of that, the Robinhood situation, the zero fees, is it's gotten people at least in the game. They're trying, they may not be succeeding, but they're taking ownership of it. And I think ultimately the long game is going to be good, because we're going to live a lot longer than we think we are. They're not going to let you pass away, actually, because if you have Social Security or whatever check, they're going to keep you alive. I might end up with my head in a jar. As long as my Social Security check is coming into that facility, I might be there. I may not be able to trade at that point, but I think, and that's how I approach it. As I look forward, and if I have another several decades here, you can't just not do something, right? You've got to do something to keep that cash flow and income coming in.
Right. And when you started with this, this path, I'm like, the 80s cult, they want that, back, right? So that's what it used to be, right? It used to be this idea of you went to work for a company, you went to their, the pension plan way back, now more 401k, but that's gone, right? Like you mentioned, gig economy, that's gone. And even if you have a 401k and you're putting money into whatever, what are you going to do after you get done? After you are at a point where you start to take that out. The challenge you have in today's environment is you have to, if you don't financially educate yourself and understand how to make your money work for you, you're going to have a problem. And it no longer is just dedicate your life to this company and they're going to take care of you with a 401k or pension and you have a nice retirement. That's no longer the case. And even as you mentioned, the gig economy, that didn't exist. You better do it yourself. So I like the fact that Robinhood is bringing people into the market. My only challenge is is the information they're giving enough for people to really make strong, educated decisions? And if you look at size of account there compared to some of these other firms, it's pretty clear that it's the starting group. It's not the ones that really, are in there actively managing larger amounts. And quite honestly, they just don't have the tools for that yet, right? So yeah, I'm glad that people are joining in and taking that responsibility of their financial future. It's going to take a little while for some of those tools at places like that to get up to speed. And again, that's what we're trying to bring to help people get better results quicker and be able to understand really their financial picture quicker than what we're doing.
By the way, you mentioned fractional shares a couple of times. I did want to comment on that because there's actually a lot of logic to the fractional share thing for brokerages trying to stand out, right? Trying to differentiate themselves from other brokerages because, what happened was, didn't used to be there was much of a need for fractional shares. Stocks used to split all the time and prices stayed normal, right? And if you remember where some of the pricing was on some of the stocks back in 2008 at the bottom, there was no such thing as there were barely any double-digit stocks, much less triple-digit stocks, right? But then we go on a 12-year run and you've got stocks like Google and Amazon and Apple, stocks that people want to own who just refuse to split like they did in the old school, like in the 90s and whatever. And so what happens is, the brokerages start thinking, well, how could we, if we could come up with a way that people could trade these stocks, even if they don't have, $3,000 for one share, right? That's going to be a way to market something that we can go out and get new customers. And that's why they started figuring out ways to do the fractional share stuff. Now, of course, after COVID hit this year and the market plunged, suddenly Apple splits and Tesla splits. Why does that happen? Because they want to make more people capable of buying their own stock, right? So it may be undone, but it's like those types of things are what revolutionizes the industry from time to time, is somebody realizing, okay, there's a hole here, people can't be involved, and so we're going to go focus on that, and maybe it works and maybe it doesn't, right? And the fractional shares are a great example of that.
Right? Should I do this? How much should I do? So they're more at risk than the Robinhood guy or girl that's got $300, so I think blowing out your account when you're younger, because I've done that before. I've
done that before.
Yeah. So I think they're able to get, and you think about that time in the game, but I forget what book it was, and it was like the people who lose the most money in the markets are the one with the egos. It's the lawyers, the doctors. They come in, they've retired, they got all this money, they were looked up to, they were leading things, and then the market just makes a fool of them, right? So I think that they're getting a cheap education, right? As opposed to, I probably paid a little bit more when I was experimenting and that kind of thing, but I want to bring it back to the educational tools and things about backtesting. I know you guys have been working on something. I've test drove it a little bit. Tell me a little bit about iVest and how that got started.
So one of the things that I was doing when I was at Ameritrade was I kept bringing things to the table that I wanted to see in the platform, and quite honestly, it was very difficult to get that. If you couldn't show, and I mean, this isn't unique to Ameritrade. This is the way the game goes. You got to be able to show where this is going to bring dollars to the firm in a pretty tangible way to make that happen, which usually means trade lift at a brokerage firm. How can it generate more trades? Well, backtesting doesn't generate more trades. It's a tool for you to get a better understanding, and hopefully long term it does, but it's kind of hard to quantify that at a firm when you want to bring that feature in. Well, there's two features specifically in our platform that are incredible for learning and understanding and improving your results, and one of those is backtesting, because the ability to go in and we have an extensive options backtesting piece where I can go in, set up a trade on a particular day, move it forward, and see how that trade would behave. I can compare different trades at the same time over an event, let's say an earnings event or a stock split or some other thing, an acquisition, whatever. So you can see how these things behave, and by understanding that, you learn a lot more about what's the right approach to take. And versus doing it with, we also offer virtual accounts, by the way, so you can have $100,000 of play money to work with, and without risking real cash. But the problem with that is it still takes time, right? You still have to have time for the trade to do whatever, and you don't know what events are going to happen when necessarily, right? Where the backtest, you can go, oh, these things happened. If I put on this type of trade, or maybe compare a couple of them at the same time and go through that event or through that run or whatever, it can let you see and gain that experience of how that type of trade is going to behave. So the backtesting shortens the learning curve tremendously by being able to look at any particular market condition, any market event, whatever, and be able to look at what would happen if I rode through that event. And by the way, if what would happen if I rode through it with the stock? What would happen if I rode through it with maybe an options as a protection position versus just so it gives you that kind of ability really quick. And then you
mentioned something. That term trade lift, that was interesting to me. I'd never heard that before. I would actually argue that that they're right, that the more you backtest, you probably trade less, right? Because you're in theory smarter. At least that's been my experience, where I'm like, I'm more patient, I'm less impulsive because I'm looking for my certain event to happen. Mm-hmm. So they probably knew that adding backtesting to Thinkorswim or whatever wasn't going to
generate the same. Yep.
Yeah.
And we have 20 years worth of options data to be able to go back and backtest, and 25 years of stock data, actually longer than that. But you can go back and see how how things would behave over the 2008 meltdown of the market. We have the recent with COVID and how that impacted things, but there's been several events over the last 20 years that you could go and see how what would have happened if you rode through those. And it's they call them black swan events, or like the once in a lifetime, except that I've lived through 4 of them. So, and I'm not that old. So, I'm not that young either, but the thing is, so understanding how to ride through those, you gain a tremendous amount of experience, and you do it in a backtesting, you're doing it without the risk of capital, and that's a really important one. Mm-hmm. And then there is one other one that we have that I think is worth mentioning, because you hear about it, and all sorts of educators and books and all that talk about the importance of journaling. but the vast majority of people don't do it because it's so difficult. And one of the things that we've done is we've created an auto journal process. So when you do a trade, it identifies the type of strategy. It'll automatically identify over 70 different types of strategies that you could be doing. It'll track that trade. And then, for your listeners, one of the things that I talk about when we're talking about journaling, and this is platform or, in a book or on Excel, whatever, I recommend always, what's the strategy you're doing? Where did you find it? Because where you find, if I'm listening to, Mad Money and I'm getting ideas there, or I'm getting ideas out of a particular website or, Wall Street Journal, whatever, are these working for me? So where I found it, why am I trading it? And what's my exit strategy? Right? How am I going to ride this through, and what's my exit point? And then when you do exit, did you follow your rules? Did you follow what you said your exit strategy was? And if you just do that, what the strategy was, to know whether the strategy you're trading is working for you or not. Find out where you found it. Is it working for you or not? Is your approach working for you or not? Are your exit rules working for you? If you look at those 4 points, and be able to look at what of those are working and not, and the ones that aren't working, stop doing, and the ones that are working, do more of, that right there is going to improve your results. But if you take what's not working and then go to like a virtual account or go back to backtesting and adjust the strategy, adjust your approach, and then bring that back to your trading, to your real trading environment, as you start to see improvement on that, it's just a tremendous value. I think that effective journaling will do more to improve your results and improve your income from that than anything else out there. Backtesting facilitates it quicker, right? So you can learn quicker, but journaling of what you're actually doing and seeing what that is and keep working on what's not working well and do more of what is working well can help those results tremendously.
One of the cool features about the journaling on the platform too is, so like, let's take an example, right? Let's say we're talking about all the trades that I did from the Wall Street Journal. I can tag that every trade as I do it, what we call hashtag Wall Street Journal, right? Or if it's let's say they're bull call spreads, like I do a bunch of bull call spreads, they're automatically hashtagged by the platform because it recognizes that. And then it puts them all together, right? It says, hey, over the last 6 months, you've ran however many of these bull call spreads, and your average profit or loss was this, and your average win ratio was this, and the average number of days. And you can just see it visually. And now wait, am I good at these bull call spreads, or am I not good at these bull call spreads? Am I getting good information out of the Wall Street Journal the way I'm looking at it, or trading it, or am I not? But the other thing that kind of happens with that is, or the thing I find useful is, on our platform, you can also then go to a stock, and it will display your past trades. It'll draw a line from where you started the trade to where you ended the trade, green if it was profitable, red if it wasn't. So now you can visually see how you've traded the stock over time. And if you hover over those lines, it'll show you like the P&L and everything like that. So not only can you break everything down by type of trade and see what the net results of any type of variable that you've been tracking are, but now on the charts themselves, you can also see all these trades and be able to tell, hey, at this point in time, why did I run this trade, and look at the chart and go, was that a smart move or not? And you can see it right there. So I think giving people those types of tools, and I did want to throw in one other thing on the back testing, which is we also have customizable and preset scans. And one of the things you can do in the platform is, okay, I want to run this scan every day, and let's say it comes up with 20 stocks in the market that meet that criteria that day. And then you say to yourself, well, okay, before I run these, do I believe this strategy, this scan returns winning trades or not? Well, now with our back testing, you can go back and run the scans. You can pick July 1st or whatever earlier in the year, and you can see what stocks came up in the scans that day. And then you can pretend like you started the trade that day, and you can see how it works. But you can stop to any day along the way and see if it's working or not, all the way to the end of the trade. Now you know whether or not the scan is giving you good stuff or not, that you should then be more confident in it moving forward. So there's a lot of tools like that in the platform, and you just don't see this at the brokerage firms right now.
With the journaling, and I totally agree, it does help. And I think with options, it's really hard to journal because, like, for me, I know, I trade a lot of SPX, SPY, but on different time frames. So I'll trade like weekly SPX, but I might trade 30-day SPX. And even though it's the same ticker, and sometimes, I do a lot of vertical spreads, being able to track those separately and not just get like, because I know in Thinkorswim, it'll just say, oh, here's how you've done in SPX. right? But that
Right.
doesn't tell me that my weekly option strategy necessarily is better than my monthly strategy, if you
Here
will.
you can know how you did in SPX, how you do with bull calls, how you do with bull puts, how you do with your weeklies, how you did with your monthlies, right?
Yeah.
All at the same time, right? And so, yeah, that's a big part of this. Of how do you work to get the right information for that? And and by the way, the other thing about this, you mentioned with options being difficult. I'll tell you that there's quite a few different ways there's different things out there for stock journaling. Most of them you have to either enter them in or import or whatever. One of the things about us, it's all automatic. But the thing with options is there's nobody that touches. Options are really, really difficult to journal, and
especially if you start rolling, and I think that's where it gets. If you're selling naked puts and then you get assigned, and then you start selling calls, being able to sort of, wrap that strategy under an umbrella is difficult, I think.
It really, and it's one of the things that we actually do. Let's just take a simple strategy of a covered call, right? So you do a covered call this month where you've bought the stock, sold a call, and now that expires. You sell the next month, and then that one's a little bit in the money, so you roll it, you buy that back, and you sell the next month. What this will do is we have this concept of life of trade, and it will bundle all of those together through the entire thing. And I have one I did on ABC that I was in it for 9 months and did 16 trades over 9 months on that particular stock. Again, doing a lot of weekly stuff and rolling it. And it bundles that all. So you can see each of the moves, but then you see the bundle as well. You see the complete picture of the whole life of that trade. And it really helps you to be able to understand, what your results are and how it's playing out. And even things like if you do some of the really complex, the more complex ones like iron condors, and now you have to move one side of it because how things are going. The fact that you can see that all together and keep track of it, it'll actually even keep track of your adjustment moves by itself. The adjustments, anything you did that. It'll also keep track of how many trades you rode through expiration. Sometimes people, they get in a trade, it starts to go the wrong way, and they get, deer in the headlight, and they don't do anything, and they ride through expiration, and then they're getting hurt. Where, if you're properly managing it, cut your losses and ride the right ones through, and then you can see how that's playing out. Those type of things are invaluable. And we're talking about the platform there, but even if you don't do that, to journal will give you so much insight. The challenge then, if you're going to use a Excel spreadsheet or a logbook of some sort, how do you aggregate and get the insight out of that? How do you see how you're performing on length of time in trade, or how are you performing compared to the S&P 500, or what's your win-loss ratios and how's your portfolio growing? All of those things are a lot harder to do if you don't have it automated, right? And people just don't keep up with it. And so that's one of the things about this. Yeah. So it's one of the most powerful parts of the platform is the journaling capability to improve your trading results.
Nice. I'm guilty of that, of not properly tracking. So let me ask you, let's maybe back up just a second. So Market Gear, or the trade tools, sort of an API into your brokerage. So you would place the trades in your platform that would flow through to, like I use Thinkorswim, for example. Is that how that works?
Yeah. So Thinkorswim, which is part of TD Ameritrade, right? So any account with right. So basically, what happens is you would come into the platform, you would set up an account, you'd choose a brokerage firm that we link to, and it's Ameritrade, E-Trade, Ally Bank, Choice Trade, Trading Block, all these different ones we connect to, and then you have full access to your account right from the platform. Your account balances are going to be there. Not only that, all your positions are available for you, so you can see all that. Your order status when you place a trade, and I know the users can't see this, but you see me click around the screen. What you see come up here is my call to the brokerage firm to get these positions, and then I can see all that. So it doesn't matter where you trade. It works with any of those firms, and we just connect to it, and we pretty much have had it set up. Unless you're going to transfer money in and out of the firm, everything that you need to know, from your gains to your positions to all that, are right within our platform. So you don't have to leave that to do that. You just do your trading right from here. And you can flip very easily between, oh, I'm doing a virtual account. Oh, I like this trade. Let me go do this in my real account. Oh, now I want to do this one over at my, like I have my IRA in a different account than I have my active trader account. I just flip between them. And it's just,
I was going to ask, can it connect to IRAs and things?
Yes. It can connect to, if it's a brokerage. Now, 401ks, it depends on the firm, because some firms do allow self-direct. Right. But certainly your IRA, your trust account. I have a trust account connected at Ameritrade, actually. So you connect to different brokerage firms all in one platform. So even if you have it at different firms for some particular reason, your trading experience, no matter which firm you're trading at, is the same, because it's one platform and just connects these different ones.
Interesting. And where's the platform pulling the pricing and stuff data from? Is it pulling it from the brokerage, or is it pulling it from online?
So what we do is for all of the fundamental data, for institutional data, for all this stuff, we're pulling that from direct sources, like, for example, for earnings, that we're pulling Morningstar. We're actually pulling SEC filings for the institutional activity, the 13s that are filed, and we pull that straight in. And then for pricing, we have a couple options. One, we do have quotes available through the platform, but you also can pull the quotes direct from the broker. So if I have my TD Ameritrade account, I'm getting quotes directly from TDA. They're real-time quotes, just like you would if you're on the Thinkorswim platform. It's available to you or on their website, and we get it directly from. And the firms really want us to do that, right? Because if you're trading with Ameritrade, they'd rather provide you the quote than from some third-party source. So we connect right with the brokerage firm for those. But all of the other data we house. We get it from those sources I mentioned, but we house all that because that allows us to mine this and help provide insight in the platform that would otherwise be a little bit more difficult to get. If I want to go in and do some, for example, if I want to go in and do some earnings analysis and look at, well, compared to their estimates and their actual, how are they doing? Are they hitting their numbers? Do they have a good trajectory? How's their growth in particular areas going? We have that readily available right within the platform for them to do, target prices, things like that, all right within the platform, very easy to access. And one of the real big focuses we've had is, how do you keep it simple and yet keep it robust? And that's a big part that we focus on how we layer information, give you a snapshot when you want it, we call it the dashboard, and then from that drill into what you want to. But if I just want to know how fundamentals are, I can see it in a really quick little thing. Then if I want to dive into that, I can't, right? So by housing all the data, we're able to do that pretty effectively.
Nice. Yeah, I looked around in there, and it's in the web browser, and it was pretty responsive. I thought I was sometimes with.
By the way, that takes us back to our original topic, which was how the industry is sitting right now when it comes to technology, and our stuff is literally just a few years out. I mean, we've made a couple changes along the way, but our stuff is literally just a few years out. So we've got the latest tech behind all this stuff, and the fact that it is as fast as it is, whether you're in the downloadable version or in the browser, as you said. It's always that way because of how it's designed. I'm sure Rance can talk more about the tech side, but this is just the difference is everything should work this fast in a browser at this point. The browsers are fully capable of doing it, but most of the brokerage platforms are built on tech that they can't get there.
Yeah, I've seen that. So one of the things in there that I've never used this, but it's like I see it and it seems like it's helpful. But you mentioned the institutional activity. So did you say you pull that from the SEC? Is that where that? Yeah,
right. So what happens is the institutions, the institutions have to file what's called a Form 13, and there's different ones depending on what they're specifically reporting, like the 13F or so on. So what will happen is that with a particular company, I can see very quickly who the top holders are. I can actually go in on a company and I can see all the institutions that hold this, how much of it they hold. I can even look at how they have grown in this position over time. Like, this was, I'm showing one on the screen, which you guys can't see, but I'm showing like they were in and out of this a bit in the case of the bank right here. But I can see how they're being held over time. But then on top of that, I can see how the institutions are playing with that stock. right? So are they going in and buying more and whatever? So one of the things that I'll tell you, it's been invaluable for my personal portfolio is that I read on the coattails of what institutions are doing. I would describe it as an institution's like one of those big tankers out in the ocean. And when you're first starting out, your account's more like a jet ski. You can just pop, bounce, and head in a different direction, where it takes a tanker a long time to make that move. So when you see the tanker making the move, you start jumping in. So you're not going to pick up when they first get in, but they don't buy it all overnight. They buy it over a period of time. And so as they're doing that activity, you get to still benefit from the rise from those going into it. So I can look at a particular stock and see what the institutions are doing with that stock. Or I could even go into a specific institution now and see what the top holdings are. So I can look at it in either direction. And so, if you look at it from that perspective, and you want to see, okay, well, let's just take an example, Vanguard Group, for example. I know one of their biggest holdings happens to be Microsoft, and you can see how they've been, how it's been growing over time with Microsoft, and how they're still acquiring more of it, and so on. So it gives you the ability to look at it either way. And I find that, the institutions, right or wrong, the institutions drive the market, right? Especially when you look at a stock, which we also, by the way, track in here, which is what is the percentage of ownership that the institution has of a particular stock. And so if you see that an institution has a very high a percentage of ownership of a stock, they're going to really drive the movement of that. And so you see what's going on there. You see they're still acquiring more of it. You ride on those coattails. That's been a big part of my what I'd say my medium-term holdings in the last couple decades I've been into this. Is I want to make sure the institutions like the stock, right? And are we seeing an increase in institutional ownership and things like that, and be able to ride that wave? And you can go everything from a dashboard into a deep dive to literally see which institutions, how much they have, how they've been adding to it, and again, be able to ride that wave if you want to.
Now, do you think that works? Do you think that works the same way as the ETFs like SPY, QQQ? Are institutions actively just buying those as well, or do you think they're still more, stock picking inside of their own?
Well, no, most institutions are still operating from the standpoint of being in the individual positions, although institutions definitely play with the broader indices as well, like SPY or DIA. Like, for example, I know that right now SPY is almost 60% held by institutions, but it's actually been decreasing over the last quarter. And we've looked at volume around specific ETFs and around stocks that make up those. Like, for example, we actually did some research just recently, and we looked at the options activity on SPY and SPX, but then we also looked at the options activity of every one of the 500 stocks of the S&P 500, which is what SPI represents. And the institutional activity between the two are not the same. The individual stock activity is still driving a lot of what's happening with it versus the larger bucket of it. But absolutely, the institutions are also using the ETFs, but majority of it is in the individual stocks.
Individual stocks, yeah.
Yep.
That's what I thought. But yeah, man, I can't wait to get a little more time in there. I know we're kind of running out of time today. I don't want to. I'd love to have you guys back on to talk more about this. I want to get some more experience with this. But real quick, let the listeners know how they can get a hold of this and try it out. Maybe give them the website. You mentioned you might be able to set up a page for them, for the listeners.
Yes, yeah. So if you go to marketgear.com, marketgear.com is our retail product, and you can see the information about it and that. But if you go to marketgear.com/Eric, we have a page specific for your listeners. And what we're actually going to do for them is give them 50%. First of all, it's a 2-week free trial anyway. But then beyond that, we'll give them 50% off for the first 3 months on the platform. So we'll give them a really nice savings on it. Let them see what see what it's like. And we want to give it long enough of a benefit that you could see the real value in journaling and using the backtesting to improve your trading and things like that. So we wanted to give you a good amount on that. So we're going to do the first 90 days first 3 months at half price, and the first 2 weeks for free. And all you do is marketgear.com/Eric.
All right, that's ERIC.
And by the way, getting on the platform, we do fairly regular webinars, to teach people on the platform how it works, show them all the features. We do one on stocks and one on options to kind of separate them out because there's so much in the platform. You got to break it up. But we also do, stuff about different option strategies and stuff as well. So getting in there and you'll get the pop-ups in the platform to let you know when those are scheduled next, and you can sign up if you want to come learn about options themselves or whatever.
Yeah, I signed up for one of them next week. I think it's the options one, so I'm looking forward to kind of seeing that and see what I could do. So this was awesome, guys. I really appreciate it. And I know the listeners can't see it right now, but it really looks nice, and it is very responsive in the web browser. So I'm looking forward to tinkering around in that webinar. And I appreciate you guys coming on the show and hope to have you back.
Look forward to it. By the way, just you mentioned with the browser thing, we actually also have app for Android and Apple for both the tablet and the phone, and we also have download for PC and for Mac. So it's a little bit faster, but the technology we're using and how we're doing it in the browser is still really fast. And
you can still issue trades from the mobile apps.
Yep, you can issue trades from the mobile app. Yep, you can do everything. In fact, the full functionality. There's a little bit of a real estate thing, so you have to move around a little bit sometimes. But for even journaling and all the scans, all that stuff is available in the mobile app as well. Yep.
Over half of our users now log in through the mobile app. So.
Yeah, the journaling is something I need to get better at. So I think that's one of the, if I can consider placing my trades through the platform and just start looking at that for a while, I think that would
help you out. I'll tell you, you'll get some interesting insight when you do that. It's amazing. I mean, when we first launched it, I would have sworn I was really good at straddle plays, and because I have all these bragging returns, right? These ones that those ones that you tell, I made 140% in a week on Amazon, but then I'd have all these little ones that 20% loss here and there. Well, at the end of the day, I was not getting the results I wanted, and by stopping it in real accounts, changing my approach. And then, and seeing what it was doing, and actually I did the exact thing the platform does. Use backtesting, change my approach. Okay, I think I got it down. Now let's go do this in virtual. Saw it was working, move back to real. And it's just a tremendous ability to be able to do those kind of things. And that's a big part of what we've developed in this.
Nice. Well, guys, I appreciate it. I'm going to put all the links to the websites in the show notes. For those listening to the episode on the podcast, you can go to stockmarketoptionstrading.com for the latest episode. And when it comes out of YouTube, I'll put those links into the description. And I look forward to it. Thanks a lot, guys. I appreciate it.
Thanks very much. Appreciate being here.
Yeah.
Thanks for listening to the Stock Market Options Trading Podcast. To join our community of options traders, head on over to patreon.com/vertical spread options trading for details. But before you go, you should know that everything discussed on this podcast and in this episode is for informational purposes only and should not be considered financial advice of any kind.